In terms of what's happened this week, the Japanese bond market and the bond yields have hit all-time highs. We've also had stories in the UK that the UK is going to have to sell more bonds ahead of the government. David, just to kind of give listeners and viewers a bit of an overview into why the bond markets matter, particularly when it comes to government spending, because I think people have a little bit of an insight with the gilt crisis under under the Truss mini budget.
Yeah,
I still don't think people really understand how they're correlated and why.
Let me, because first of all, thank you for inviting me on. But let me start off with the UK market, because I think it'd be easier for some of your listeners, if they're not au fait with it, to understand it. The government has one way of paying on its balance sheet for our requirements, which is basically the public sector, which is education, which is defense, which is any number of things that I could go through, roads, railways, loads of things. That is done by two ways. It's either taxation or borrowing money through what they call the gilt edge market. And the gilt edge market is guaranteed by the government and is sold either to retail investors if they are rather conservative and they just want to know that they're going to get a certain dividend every half year, and that for certain gilts, as you know, you don't pay tax on it as well. And basically that's how they, so we've got a problem now with this country. And I'm going to sound a little bit like an anorak, but I think it's quite important that your listeners actually listen to what I have to say about why the world's borrowing has got completely out of hand. When Ken Clarke was Chancellor of the Exchequer in 1997, when John Major was the Prime Minister and handed over to Gordon Brown, we were borrowing in total, the United Kingdom of Great Britain and Northern Ireland, £350 billion. Just before COVID, in 2020, in March 2020, we borrowed £1.8 trillion. The debt 5 years later is £2.9 trillion. Now, you borrowed that. We had a period of time after COVID when Mark Carney was the governor of the Bank of England, where we had next to zero interest rates. So you could borrow heaps of dough and it didn't really matter because you could service the debt because the interest rate was very low, and accordingly, everybody was satisfied. All of a sudden, our friend Putin rears his ugly head in Ukraine, and all of a sudden we've got a severe energy crisis, and we've got rampant inflation going up to 11% here, and whoops, the Bank of England suddenly decides, oh, we've got to put rates up. So all of a sudden, what was a manageable situation no longer becomes manageable. And this isn't something that's particularly peculiar to the UK. Interest rates started to go up in the United States. And to give you a correlation there, is that when COVID broke out in the United States, that their total debt was $24.2 trillion. Today, $38 trillion. Thank you, Mr. President, who absolutely went mad. A lot of people thought Rishi Sunak went mad, borrowing 800 billion pounds, to make sure that we all had jobs, that the dole queue didn't increase, that we all had something to eat. All right, the cheats and the vagabonds were always going to crawl out of the woodwork, whoever it was, and they'd say, oh, it's the old Tories again. It would have been anybody. And that is the fact of the matter. Joe Biden just dropped $1,200 on everybody's mail box, have a party, which actually intellectually was probably quite a sensible thing to do. Economically, it was madness. And we've now got a situation where throughout the world, we are hopelessly overborrowed, and dangerously so, in my opinion. And the day of reckoning will come sooner rather than later, I think, unless something dramatically happens, because politics interferes far too much with economic reality. Now, we're going into a budget next week, and I have been watching politics, as I'm a very old gentleman, as you probably can see, for more years than any of your listeners have probably. I've been watching it really with avid interest for 62 years. And I have never seen such a rubbish presentation that I've been witnessing during the course of the last 2.5 months. Whoever advised Chancellor Reeves that, and it should have been the Treasury and the Office of Budget Responsibility, to start playing poker with the UK economy for over 3 months is insanity personified. And the bond market will not have it. You probably know this by talking to lots of people, Kez, over the years. Markets cope really well with good news, obviously. Do you know what? They cope pretty well with bad news. What they don't cope with is uncertainty.
Mm-hmm.
And we've got it in spades now. And it's thoroughly dangerous. And we've also got, I mean, I was very lucky about 40 years ago. I hosted a lunch for Harold Wilson, who was just retiring. And he told the assembled company, and I've never forgotten it. He said, the best Labour government, he said, is one with no majority, because they do as they're bloody told. And it's absolutely right. And now Rachel Reeves and Keir Starmer, to a certain degree, are looking over their shoulder at the left wing. And the left wing will not hear about cuts in public expenditure. And that's what really is happening. So we're down to a situation where we're either up to the limit, or we may have £9 billion worth of headroom. But if any of your listeners today or viewers heard the public sector borrowing requirement figures, they would be very disappointed. Because they came in at 17.4 billion, which was roughly 2 billion more than we would have liked. It was down 1.8 billion on last October. But that's just the kind of news we don't want to hear, because every time these bond yields tick up, we have to pay more interest. So let me be just a tiny bit more of an anorak, if I might, just so that I can explain to your listeners stroke viewers. And I'm going to talk about the gilt market now. Now, in September 22, when, how can I put it, Liz Truss was at her most fertile, shall we put it that way? The 2-year gilt yield was 4.22. And now, when Labour came into power in September of, I beg your pardon, 5th of July 2020, it was 3.54. So the headache that Rishi Sunak and Jeremy Hunt had was coming down. Today, the 2-year gilt yield is 3.76. That's nearly 0.25% higher. It doesn't sound like much, but when you're borrowing billions, it's a hell of a lot of money. And I could go on like this, but I'm not going to go on there, because the one that really is painful is the 10 and 30-year gilt. And the 10-year gilt, after, I was going to put Liz Truss, it was a 4.57. When Labour came to power, it was 3.84 on that day in July. It's now 4.56. And the 30-year, when Labour came to power, was 5.545. That's slightly better at 5.39. But it's 30 years. Wow, wow, wow. And what people forget is that we've had 5 cuts in interest rates since Labour came to power, and the bond yields have gone up.
But I suppose well, there's a few points I'd make on the bond yields. The reason why Liz Truss and the Kwarteng mini budget was so distressing to the bond market was because it happened overnight and was a shock. You know, the market did not expect it to happen. They didn't expect the political announcements to happen as steeply as they did, which is why the bond market reacted quite so violently, in the way that the bond market has reacted more gradually over the year or so.
Yeah, that's true. But let me put a little bit more colour on that as well. What Kwasi Kwarteng and Liz Truss put together as an economic package, if you were a conservative, and I do put that, made actually quite a lot of sense, because it was going to give growth. What was unforgivable was not to consult the Bank of England and not to consult your own cabinet and to serve it up, as you put it, as a fait accompli. That was financial suicide, and she paid the price.
Yeah, and I think the other 2 points I'd make, particularly in the run-up to the budget, is, and actually Liz Truss had a similar issue, which is the PR around it has been absolutely appalling. Both Liz Truss did an appalling job of it, and Labour. And as a PR guy on the centre left working in finance, I'm the first one to say, whoever is advising the Treasury at the minute to drip feed ideas and to get a vote is absolutely ridiculous. You know, what the market's like is a plan and some idea that there is a plan about, even if it doesn't agree with the plan, at
Yeah,
least
I agree with that.
we
This
can
is the plan.
yeah, and the Liz Truss's fate came down to the fact of not consulting anyone, and it was a massive surprise. So that's why that happened. But the other thing, and this is the point I'd make, and this is why we're having an issue in the US as well, but also in the UK, which is people do want more public investment in certain things. The roads are awful, hospital waiting lists are still pretty high. People want more bobbies on the beat and all this good stuff. People want their pensions. But I don't think what people fully understand is that most people have already had this money. Through the COVID period, there were people were essentially paid for by the government. They've had this bailout. And I think the problem that a lot of people don't understand, and it is not a nice truth, is that most people have already had their money. It's not a popular
Not
thing.
a God-given gift, is it? That's the point.
No, but I think if you are an everyday man or woman and going, but I'm suffering right now, and I've been suffering for a few years because inflation's high, things like that. It's like, well, there was a period during that COVID period where lots of people had lots of discretionary spending because a lot of their overheads were cut, and they probably didn't make personal provisions. Now, you can't change what the tax policy is going to be in 3, 4, 5 years' time, once you've voted someone in. But what you can do is take some responsibility for your own spending in that period, because nobody knew what was going to happen in September 2020 versus March 21. People just didn't have a clue. It was a complete unknown to everyone. And lots of people then went, I've got all this free money. My sister was one of these people who took out a B-bills loan and bought a Range Rover, and go, I don't think that's the most sensible thing to do.
Right.
And I wonder if what people need to hear is actually a very difficult truth, which is politically suicide, but economically the most sensible thing to do, which is we have to pay this all back, and it's more expensive now.
Yeah. The thing is that I'd just like to draw two more statistics towards you and your viewers and listeners. What to me is unsustainable is that we have 9.2 million people economically inactive. It's insane. We can't deal with that. We've also got 3 million people on permanent sickness benefits. Permanent. That costing us now, Kes, £40 billion a year. And in 2035, greater economists than myself, well, I'm not even an economist, I'm just an observer, tell me it's going to cost 80 billion. Something has to be done.
But I would also, my argument to that would be, and these are big numbers,
Yeah.
They are big numbers. On a monthly basis, we're borrowing 17 odd billion a month. It barely, if the gilt yield goes up 25 basis points, the government is in the hole for another 10 billion.
That's
These
what I
are
mean.
fairly small numbers when it actually comes down to levers that the government can't control.
Yeah.
Is there an argument to be made that actually the amount of money we spend on, I don't want to say trivial things, because that isn't the case, and economic inactivity is obviously a challenge, and you want to get people back to work both societally and for lots
Well,
of
a lot
other
of people, if you recall, I mean, a lot of people, 50, 55-year-olds, came round to COVID and they could take their money, and thousands of them haven't gone back to work.
So do you
that is bad, because, okay, they've got their pensions, they can afford it. But I've got news for people that if they think that money grows on trees for pensions in 10 to 15 years' time, dream on. It's not going to happen. You think of all the companies, big companies like BT, have got billions of pounds worth of provisions they have to make for pensions. There's going to be a time when the kissing's going to have to stop because we can't afford it.
Do you think actually economic inactivity amongst older people, particularly 50 plus, is actually more dangerous, because these should be people at the height of their earnings, height of their careers, and as you say, lots of those people 55 plus went, bloody hell, I could just take it, particularly if they've got a private pension, draw it at 57.
Yeah.
Economic inactivity amongst 50 plus is potentially more dangerous to the economy than economic inactivity amongst under 25s, because I didn't get my first professional job till I was 22, because I'd been to university, and the job hunt for that graduate job is always challenging. But I started at 22, I think, as an editorial assistant on 14 grand in Victoria, not getting by at all. But there's people in their 50s who are no longer contributing any
That's
productivity
the point. Yeah.
to the economy. Now they're still spending and they're probably still paying tax on their pension when they're withdrawing, but they are not adding their productivity back into the market. And do you think that's potentially more damaging than youth unemployment, you know, being a target?
I think it's every bit as damaging, but I think for different reasons. I think socially damaging the young, I fear for. The trouble is the young get despondent because they've never been given a chance. And, this is why, without getting into politics too much, that national insurance...
Let's do it. Let's do it.
Yeah, that national insurance contribution was utter nonsense from the word go, because it just got the big employers finally saying, hang on a minute, for a rise in the living wage, the public sector have just had a massive increase, hence Mrs. Reeves's black hole, of which half of it was her responsibility for paying up these people. She probably would have had to anyway. But my point is that it's just crazy. And I just want the young to get a chance, and they're not getting a chance. And you make a very valid point, Kez, about 50-year-olds not putting their weight. And I think that's and I think it's dangerous, and I think it's wrong, and I think it's actually selfish. Because if we're all contributing to try and get growth going, you need every aspect from every kind of different channel that you possibly can focus into achieving that goal. And the one thing that hasn't happened is the young. I think we're going back again. Why are the young like this? Young, funnily enough, have quite an attitude problem. And, you'll find a lot of people like building companies and take people on, and there's a sort of resentment, do this job, make the tea or whatever it might be. And until people are actually focused that they want to get on, they've got to be prepared to get their fingernails dirty the same as everybody else does. And that, again, is down to education. And one of the things that I fearful now is in the education system that we have in this country, teachers are absolutely fearful of being ticked off or removed from their job for coming over heavy in terms of discipline. And parents are not really allowing the schools to discipline children when they behave badly. And if you nick that in the bud, then I think the family tree as it goes up, it becomes easier to control and makes people in a better frame of mind to get on with their lives.
My wife is a head of a pre-prep, and bear in mind it's a fee-paying school in Suffolk. There is a attitude amongst some of the parents of I'm paying you, so therefore I deserve, to have my say. And the problem is, and this is some, we've been together over 10 years now, and she started as a teacher when we got together. And when I was very guilty of this when I first met her, because everybody has an opinion on education because we've all been to school, and it unlike when we go to the doctors, we don't really have an opinion on whether a GP's practice is they do the right thing, because none of us are doctors, and there was a time a generation or two ago when teachers, bank managers, GPs were held in a position of esteem, and that feels to have been lost. And I can't tell if that's there's been a respect gone for teachers. The teaching profession itself has also been crushed. My wife will continually say, despite being at prep school, Michael Gove was one of the most damaging things to happen to the education system. Basically ripped up the rule book and decided to impose what worked for grammar school kids in the 60s and 70s doesn't work for every kid today. But I think the other thing with education is there is a mentality that the school system is there just to pass exams. And in the society we live today, and particularly in the economy we live today, there are so many ways to make money, and there are so many ways to have a career that are way beyond the scope of exams. Now, I'm sure you and I have both been through a system where, you do your exams, you go to university, you get your graduate, and you climb that corporate ladder. But I know some guys these days who have made money as kind of, building consultants, for example, because they started as, as a self-employed roofer, for example, and then realized, well, actually, I'm really valuable by actually going in and basically putting in a bit more of a kind of consultant hat on as a privateer in the way that a site manager used to. That job didn't exist even 10 years ago, and these people are creating their own jobs. But there's not an exam for that. And I also have a concern. My only lesson of personal finance education was learning how to write a check. I've never written a check.
I know it's extraordinary, but I mean, it's just the way that life's moved on. But I just generally believe that if you don't give reasonable scope to the teaching profession to set down their own rules, which are obviously not physical or anything like that, but you know what I mean, unless you give them the freedom to deal with their own discipline, we're never going to sort this one out.
So let's go back to bonds, because the Japanese market has been tumultuous. You know, politically, they've had a big upheaval recently, but their bond yields have hit all-time highs. But they also have a colossal debt to GDP ratio. Why does this matter to anyone? Because, you know, I'm over here in the UK as a retail investor with my stocks and shares ISA. Why should I care what's happening in Japan and in the bond market?
Well, one of the differences, Kez, is that if you go to Japan, as you so rightly pointed out, the level of borrowing in Japan just blow your brains out. I mean, I can't tell you. I think it's something like 134% of GDP or something. I'm not exactly certain. But as individuals, Japanese people save, and they are the main buyers of the bonds. So on a Friday, if you're stuck outside Bank of Tokyo Mitsubishi, or whatever the bank's called now, it doesn't matter, you'd see, you know, 24 ladies in carpet slippers, because the women run the finances for the homes over there, queuing up at the bank, and they've got 1,000 yen for Marita, they've got 1,000 yen for Ichiguga, or whatever it is, they're all going to massive savers. So their figures economically look terrible, but in point of fact, they are more in control, not so much in control, because people in Japan are natural savers. It's part of their DNA. But as you so rightly say, I mean, we've seen the 30-year. I mean, when I was in Japan, was just about when interest rates were starting to go up. But before that, between, say, 1987 and 1997, I mean, rates were almost zero in Japan. And that's where it's been really dangerous. And I think a lot of people would criticize Mark Carney for the fact that he took interest rates down to low levels, when before starting to take interest rates down, he should have dealt with quantitative easing, which we knew was going to be very inflationary. And I mean, people like me are very irritating because they're always hindsight, and they criticize people when it's, you know, the horse is bolted. But I think there was so much chat about that. I think in Japan now, I mean, you've got the 30-year rate went up 5 ticks. Well, all I can say to you, Kez, by our standards, is whoopee to 3.39. And the 20 years went up, I think, 2.8 ticks to 2.85. So it's not going to kill them. And Japan's got, what, 126 million people. And, you know, they are thought to be a very stable economy, though I'm slightly uncomfortable that they are, how can I put it to you, handbags at 5 paces with China in the course of the last couple of weeks, which I think makes me feel a little bit uncomfortable. They dislike each other as races anyway, and they always have done, you know, since before the Second World War. But nonetheless, Japan is an incredibly important economy, and you know, should not be in a situation where it feels remotely vulnerable, because the level of borrowing is pretty great. But in terms of, would I be more worried about the borrowing in this country than I would be in Japan if I lived in Japan? Absolutely. Okay.
And I suppose when you're talking about bonds as well, particularly for retail investors, you know, we've been taught about the 60-40 portfolio, and, you know, having a good stock to bond ratio within our own investments. But the stock market feels pretty volatile right now, and we've had a week of the Nvidia earnings and the market going from dark green to dark red. What is happening? Because I'm hearing some people saying there's an AI bubble, and then the AI companies appear to be investing billions with within each other. Just give us kind of your view on what's happening within particularly in the AI space, but then also the repercussions into the general S&P 500, because I think that's also a concern.
Well, I think it's a bit more than that. I think basically the Magnificent Seven, and we won't go through the Apples, the Googles, the people like that, Tesla,
Nvidia,
and all these sort of people, and Amazon and the rest of it. They constitute 30% of the valuation of the S&P 500. That is insane. So the US market, because of the Constitution, if you see what I mean, will feel vulnerable. For those 7 stocks to represent 30% value of the entire US stock market at a senior level, not all the small companies, I mean, it's just madness. So you look at Nvidia, you look at Palantir, you look at all these companies. I mean, Nvidia's results on Wednesday were, in my opinion, knockout. I mean, to increase your sales by 63%, to increase your profitability for the quarter by 65%, most people would give their arm and a leg to do that. What people don't understand or conveniently forget, suffer from amnesia, if you like, is that the valuation of these shares is off the Richter scale. And the situation is the outlook for Nvidia, if you actually had the drains up, so the professionals tell me, was a little bit short. Because the other thing you have to remember is Nvidia is very, very expensive. And when other chip makers get involved, as they will with China and various other things, they will be able to produce this stuff significantly cheaper than Nvidia, which it rules okay at the moment, does. And I think that's the reason why people have felt nervous and very uncomfortable. I don't give advice because I think it's I'm not qualified and I'm not an analyst and the rest of it. I'm just an observer. The difference between now and 1999 to 2002 is very different, because we had all kinds of Mickey Mouse little tech companies that nobody had ever heard of, 30 years ago, all jumping up. Many of them were involved in fraud to get there. So when, for instance, the tech market in the United States, or the Nasdaq as it was known, fell out of bed in 2000 and 2001, everybody was going shock horror, oh dear, and everybody was saying this is awful. And then the Neue market in Germany collapsed altogether. And all the companies that we had, like FreeServe and all these sort of other people, they all, well, they didn't go out of business necessarily, but they didn't do. Arm is about the only one that's done fantastically well since. But we don't have fraud now. And we've got actually a very, very mature tech market. So if you're in the school of telling me that you think the stock market will come down 25% to 30% sometime in the next 2 years, I'm not your mate, because I don't actually think that will happen. I think that you will get a certain level of damage on tech stocks because they're overvalued, and they will be done with specific companies, and others, could be Microsoft suddenly becomes vogue again. Cloud lives okay, and everybody wants to be involved in cloud. So it takes the focus away from Nvidia or whoever it might be. So we're due a correction, and we're getting it. We're getting our backside, good spanking. But it's not, my God, where is my life going down? It's not. We're not going back to 1999, in my humble opinion. I think that the correction is healthy. And if you see a stock that never does anything else but go in that direction, something's wrong, because everybody needs to have a bit of a shakeout, have a look, reappraise the situation. So I am obviously concerned about valuations for the next 6 months to a year, but I'm far from going to the top of the mountain nude and saying help, because I just don't think it's that.
My worry is particularly in the landscape we live of social media and 24-hour rolling news, is our time horizons are completely out of whack with most people's financial goals. Because if you actually look at what the S&P is returning year to date, it's about 10.8%, 11%, something like that. Yeah. This blip we've had of, it's gone down 3% in a day and 2.5% for the month is not representative of how most people are and should be investing their money. You know, I think, particularly when you're having these conversations on platforms like TikTok, where it's, you know, every day, every hour, you know, there's new news. It's really unhealthy for people to go, oh my word, the stock is up now and then it's down now. And actually, it's about zooming out. As we, you know, you looked at the market for decades, you have these corrections, and the market continues to grow and perform when you zoom out. I think we have an issue at the minute of people not actually taking a step back. Do you think we have an issue with particularly retail investors of being a bit too emotional, a bit too trigger happy because of the way that
I personally, I've got, I'll not say a different way of looking at it from you, but I've got a slightly more guarded one. There's two people. This, what I call, which I'm a member of, or was a member of for many years, the spivs and vagabonds, and the retail investors. The spivs and vagabonds look at a screen like you and I are looking at each other now, and watch every tick up and every tick down, and react accordingly, deal accordingly, probably very successfully, some very unsuccessfully. And I wish those people Godspeed, because they live on their nerves, and they do a copious amount of reading, and they listen to every single financial news channel, and good luck to them. And they speak, they've got a lot of mates and the rest of it in the market, and they're all doing the same, roughly the same thing. And I wish them Godspeed. It's a good business, it's a healthy business, and I hope it goes well. But I've had it proved to me that if you have a balanced portfolio, and not necessarily say, right, buy me Rolls Royce, it's gone up 180% the last year, or whatever it has, you know. What I want is 3 or 4 Rolls Royces in a fund, 3 or 4 Microsofts in a fund, somebody from Holland, maybe somebody from Belgium or wherever it might be. And it's been proven to me that if you actually have funds, ETF funds, you know, where your fund manager or whoever it is handles it for you, you are every bit and probably better off, because you will be able to take the swings and roundabouts far better, and you won't get a hammering because you suddenly nailed your flag to the mast of XYZ company and it's just hit a bit of difficulty. Okay, so it has, but if I'm in a fund and I've got 3 or 4 other stocks doing the same thing, you're better off.
And I suppose with that, would you then, let's say you know, a young 18-year-old comes up to you and says, hey David, I want to start investing. I don't know where to go. I don't know what to do. I just want to put my money away so it grows. Would you then subscribe to the Buffett school of thought, which is low cost index fund, set it, forget it?
Yep. And go somewhere like AJ Bell, who I think are absolutely tremendous. And there's many others, so I don't discriminate against other people, but that's absolutely the way to do it. And what isn't the way to do it is to meet somebody in the street and gives you the old wink and says, get on this good thing. You know, it's like it's like the 5 o'clock at Salisbury, you know. It's not a good idea unless you follow. I mean, I'll tell you a story against myself. About 15 years ago, I used to work for Cantor Fitzgerald, and I started doing a little bit of spread betting. And, you know, I thought I knew everything. And a friend of mine comes up and nods me and he says, go on, you know, log on, help yourself and buy some Ericsson it was. And I said, really? And he said, oh yeah. He said, you will thank me tomorrow, whatever it was. So I duly did that. And I went out on my rounds to do my business. And the ink wasn't even dry on the confirmation thing is when Ericsson had a rights issue. And of course I did my I did my thesis. You're going to do short-term trading, pay attention, be on access all the time. Because I'm sure you're like me, you have a full life, you've got a family, you've got other interests apart from money and the rest of it. Enjoy, inhale, enjoy every single minute of it, but do it within the parameters where you know you're safe and you're absolutely on top of your job. And therefore, what you suggested about the small funds and getting involved and slowly building your confidence up has to be the way to do it.
And are you concerned at all that the way that the fund market at the minute, particularly for retail investors, is offered actually isn't offering the diversification that people need, because I'm seeing a couple of people say, you know, I've got an S&P 500 over here, I've got a global all stocks, I've got a tech focus ETF, I'm pretty well diversified. But actually you dig into it and go, 40% of your exposure is in the magnificent seven, because they're just putting everything. Do you think there is, because my view on it, if you're not investing, just buy yourself an all market fund, global FTSE, whatever it is, and just get started, because I think just getting started in a fund is going to be better than not. But when people are trying to diversify and don't really know enough about the individual funds at that fund level, and particularly the makeup of those funds, is where they have the view that they're diversified, but actually under the hood it's very, very similar. Do you think there's a problem there that needs addressing?
Not so much a problem. I think they make sure that they are diversified sufficiently, and if they aren't, rather than make a fuss, because if you went to, doesn't matter who it is, Hargreaves Lansdown, and say, well, you've got me in this fund and I actually think it's pretty narrow, they would just shrug their shoulders and say, well, that's what our people have decided to do. So put all your eggs in one basket, I think it's quite silly, and have your diversity of the ability to look around to see where people can accommodate what you think is what you need, or you prefer the advice of many rather than a few. And I think that's important. Don't listen to any one person. Listen to lots of people, because they'll all have their own little bits to chip in that are useful, and others that you'll be able to say, well, thank you very much for your advice on that, but I'm not going to take it. But just to take the advice of one person can be short-sighted.
And if you were talking to young David at 18 years old, before your career, you're just about to step into the big bad world, and you wanted to give yourself some advice for your own personal finances, have there been any lessons that have stuck with you that go, I wish I knew that sooner?
Not really, because I think, as an 18-year-old, I started off in finance. So I was actually exceptionally lucky. But I think rather than just tip your money into a money fund, you should go and see the whites of the eyes of the person who's going to look after your account, and see whether you like him, whether you're on the same page, whether he's talking to you in a manner that you actually understand, and you're not like a nodding dog going, yeah, 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 that you actually understand. And if you don't understand, don't be shy. Ask, please break this down for me and tell me what it really means.